Well, hello again, everybody. This is John Norris of Trading Perspectives. As always, we have our good friend Sam Clement. Sam, how are you doing today?
How's it going, John?
I'm doing okay. Thank you for asking. Sam, last week we talked about who's going to buy our debt. If it's not going to be the Chinese and it's not going to be the Federal Reserve, who's it going to be? And I think we came to the conclusion it's probably going to be U.S. investors that end up gobbling most of it up, but probably not at the interest rates that so many of us were used to for such a long period of time. When the Fed sat on the long end of the curve, 10-year notes and with a one handle, that sort of thing. So I guess that begs the question, are higher interest rates here to stay?
They're probably here to stay. At least, I guess you have to back up and ask what you think higher interest rates really are.
Because that's a fair question.
Yeah. Talking about, a lot of what people look at as mortgage rates or is probably talked about more than anything.
Yeah.
Those probably aren't going back down to the 2.75, 2.65 lows that we saw for.
Well, I think if that happens, something really bad has happened.
Yeah, which something bad kind of happened to get us there in the first place. So they're probably not getting back to those levels. The equivalent of treasuries at that same time period probably aren't getting back down to those levels. So I guess the easy answer is yes, at higher interest rates when you look back where we were, 18, 24-ish months ago.
Yeah.
Those probably aren't happening for the foreseeable future.
And I guess, the real question remains is a 4.2%, 4.3% 10-year Treasury, which is about where we are today. It's rallying a little bit here today as we record on, the 23rd of August. However, the thing about it is, historically speaking, a 4.2%, 4.3% 10-year note just really isn't that big a deal to the American economy. However, is it going to be a big deal as we try to wean ourselves off of these lower interest rates? Does that 4.2, 4.3% 10-year note loom larger than it would ordinarily? Because maybe we got used to the 1% to 2%. What does the investing world look like when all of a sudden, dare I say, longer-term debt is paying an absolute rate of return?
Yeah, I think where it really becomes a problem is how, whether you're a government, a company, an individual investor, if you banked on rates remaining as low as they did, or as low as they were, if you expected that to continue to happen, that's where you really kind of run into trouble. If you thought rates were going to go back up, or you were prepared for higher interest rates, whether we're talking for something on the treasury curve, or 8, 9 something maybe in the private market, or bank debt, what have you. If you were a little more prepared, I don't think you're right, because it's not these extremely restrictive rates, and the real rates aren't that significant either. So I think it's mostly a matter of poor planning that if rates are going to be a problem for you.
Well, kind of speaking of poor planning, or maybe just poor asset allocation or misallocation of funds, let me ask you this one. As the Federal Reserve bloated its balance sheet, $8-9 trillion, a lot of it, pretty much all of it, government debt, and now it's trying to unwind it, the tune of about $900 billion a year. I think that's around the number or thereabouts. They might put it on hold and all that stuff. Do you think that those lower rates that the Fed kept us so in love with for so long actually contributed to the misallocation of capital in the U.S. economy?
It absolutely did. I mean, if we've used this term that cash is always dry powder.
Yeah.
And it is always dry powder. It's still nice to probably have some, even if you're not making a lot of money on it. There's still some value to that. But when you're making literally nothing, or essentially nothing, you are going to be pushed further out kind of the risk curve and get into assets that are actually going to be appreciating more, hopefully appreciating more. And what that typically means is it has to mean, for the most part, taking on more risk, because unless you find something that I don't know of, you have to take more risk for more return.
Well, you're absolutely right. And Sam, I've got a spreadsheet on my computer that took Ibbotson data from 1926 all the way to 2005, or about 2005. After that, we started Oakworth. I wasn't going to pay for the Ibbotson data, so I just went to the Bloomberg and used the equivalency. S&P 500 or RTY for small cap, all that stuff. And I've just recently updated all the way through 2022. And, there's something called the equity risk premium, which I know you know about, but people listening to this might not, but they probably do. And that's the spread that investors need to see over a tax-free or over a treasury or some sort of risk-free type of rate of return. Boy, I struggled with that. I'm so sorry with that, because I can't think of the treasury as risk-free any longer. But, historically speaking, Investors have needed to see, I'm going to round up here because it changes with every year. We've had a couple of negative years in the 10-year over the last couple of years. Investors have needed to see about a 5% rate of return. About a 5% rate of return.
Over.
About 5% on intermediate term treasuries and about a 10% rate of return on large cap stocks. And I'm just going to round down on this one, about 11% rate of return on small cap stocks. So if the 10-year is at 1.5%, and we're assuming that equity risk premium of roughly 5 on large cap, 6% on small cap, if I can borrow money at 2%, then all I really need to have is a rate of return, arguably of 7 to 8%, which is less than the historical rate of return for stocks just in general. So if investors are thinking that I can borrow at 2, make 8, and pocket my 6%, I'm okay with that.
Sure.
And as a result, arguably maybe we misallocated some funds or private equity or what have you and went into some investments that maybe weren't the best ideas, but they were okay when money was cheap. Now, however, does it really make sense to open up another coffee clutch when you're borrowing money at 8 or 9% and you need to see a 15% rate of return?
Well, and a great example of this in the public space is the banking issues we saw in the first quarter. That's exactly what a lot of these poorly managed banks were doing. This wasn't a banking crisis that banks as a whole were in trouble. Yeah, rising rates causes problems. But when you were going so far out on the risk curve and the risk spectrum to kind of, juice the yields a little bit more, make a little bit more money because you were fine with that, even though the yields weren't great, they were better than making nothing on it. And people got kind of over their skis and companies got over their skis.
Well, I would completely agree with you, and I want to go back to something that you were talking about in terms of, when talking about dry powder, having cash, overnight liquidity. And, when overnight liquidity is paying 10 basis points, and you have an investment advisor that's charging a account level fee, it is absolutely costing investors money to maintain to some of that dry powder.
Even before inflation.
Even before inflation. So as a result, it was anathema doing what we do for a living to keep even a 3% cash call. I mean, you have to keep a little bit of something for withdrawals and what have you, but you keep it as skinny as possible, throw it out there in some asset class, just trying to get an absolute rate of return so the client doesn't have a negative experience and negative rates of return on their cash. Now, however, cash paying 5+%, all of a sudden investment advisors across the country can be a little bit more judicious with how they invest their clients' money because they're getting a 4% plus sort of net return just by sitting on cash and waiting for the next best thing to come up. And as a result, I think that's arguably good long term because instead of just throwing money at something hoping it'll stick, you're now actually doing some homework. And you need to do something more than just, frankly, we all did in 2020 and 2021. Just put it into the markets and it'll go up. Now you actually have to do your homework, and hopefully that will lead to higher rates of return moving forward. Yeah,
it just changes the lens that you look through every investment on. What's the risk-free rate, essentially cash? What can you make on cash? And obviously, we both know, and a lot of people know that, the Fed hikes interest rates for a lot of reasons. Mm-hmm. But one of the first reasons I learned in my high school economics class was that it makes, shifting out of stocks and shifting out of other things into, bonds and other assets. That's typically why it was one of the easiest first reasons to learn why that markets typically don't like higher interest rates. And it's a lot more complex than that. But you're right, it shifts the lens. It gets rid of some of maybe those throw money at everything and kind of bubbles that you can see because why not?
Well, you're absolutely right in asking the question, why not? And I'm going to throw this one particular asset class at you. And this, you have to remember, going through the little caveat out there, anything we say here on Trading Perspectives does not constitute an offer to buy or sell investment securities or financial services of any type. Any decisions that you make based on listening to this commentary or discussion that Sam and I are having, you do so at your own peril. Now, with that being said, Sam, let's think about the old cryptocurrency space.
Yeah.
I mean, I would say that's almost a perfect example of what happens when money is essentially free and people are just looking for something, anything in which to invest.
Yeah. Yeah, and it's, you have to, there's most of it, I would say, at least in my opinion, is speculative right now. The actual real use case is not very high. And so when you just focus on even speculative assets in general, that's typically stuff you're willing to take so much risk on.
Yeah.
And those are, again, the things, those tend to, I think, be probably the first to go. And, that can mean several things. That can mean companies starting to invest less in that space or what have you on things that are really, really long-term projects for them and they don't view as money makers for quite some time. So there's going to be a lot of headwinds for, typically starts, I think, as far out on the risk curve as you can go.
Yeah.
And that's kind of up there. We've seen it with private equity. We've seen it with venture capital. And Bitcoin is, those are obviously different asset classes, but as far as the risk curve goes, those are all pretty out there.
And speaking of private equity, well, that's always going to be an asset class out there. There's always be some appetite for it. Companies like KKR and Blackstone will always be able to find some deals. It is amazing to see just how quickly the deal flow has dried up in private equity.
Yeah.
And the deal flow that is getting done now is some of the smallest really since 2005, if I'm not mistaken. And as a result, while these companies get to price their assets maybe a little bit differently than how we get to do it with a pricing matrix, those massive rates of returns that I think people were getting used to out of their private equity investments probably aren't going to come to fruition over the next 3 to 5 years because the cost of money is just that much higher.
Yeah.
And so I could say the same thing about cryptocurrencies. And and Sam, this, over the last 5 to 6 years, we've had a bunch of people question us, why not cryptocurrencies, why not private equity? And, for a number of different reasons. And now all of a sudden we kind of take a look at things going, well, why not cryptocurrencies? Well, listen, there are people that bought Bitcoin at $2.50 and they've made out like a bandit. I'm not good for you all. However, in 2020 and 2021, because money was so free, just absolutely creating money out of thin air with fiscal policy, with monetary policy. If I'm not mistaken, we saw Bitcoin go up to close to $80,000 at one point, 2021.
Probably.
Or we're up
well
upwards,
over 60. I know
well
that.
over 60. I mean, just it got on up there. Ended, I think, 2020 around 47, 48,000, and it's been in one-way direction pretty much ever since the Fed has started raising the overnight lending target to, as it trades currently today, at 26,000 and change, which is still, again, fantastic if you were one of the early adopters of it. But if you are sort of a late Johnny-come-lately or someone that's been interested in it over the last 3 years, you very easily could have lost your shirt. And so I would say that that's one of those perfect examples of when money's free and all you need is a 5 to 6% sort of rate of return. Let's say on more speculative investments you need 8%. Well, okay, I'll go take a flyer on this thing that exists out in the ether, that there's no physical characteristics to it. There's no truly an intrinsic value, but I'm okay doing that because it doesn't cost me anything to borrow and invest in it. Now all of a sudden it costs me something. I'm going to see that. I'm going to need to see that significantly higher rate of return.
Yeah.
And then that's going to lead to people going, I don't know about NFTs, paying $1 million for a picture of an orangutan out there in the ether.
And we've seen that. We've seen that in all those even more speculative than cryptocurrencies, those kind of derivatives of it. We've seen a lot of that. I think one thing that's really hasn't been talked about, though, and there's a lot of negatives to higher interest rates. It can slow things down. It decreases the amount of lending, or can, when you have an inverted yield curve, all that stuff. But on the flip side, we've talked, people are still saving a decent bit of money. And now all of a sudden, people are making money on savings.
Yeah.
That's pretty stimulative when you can go out and make 4 or 5% on your savings.
Now, which begs the question, I think we've all been taught, or all learned, to use a more active verb tense, we all learned in various business school classes that lower interest rates stimulate economic activity.
Yeah.
However, is that necessarily the case longer term? Because every time that we've seen persistently low, arguably manufactured interest rates, we see below trendline economic activity. We've seen it in Japan, we've seen it in Europe. Heck, we saw it in the United States in a lot of ways in terms of overall economic activity. And if that's the case, lower rates can stimulate. However, low rates arguably don't. Could that be just due to the old equity risk premium? If I can borrow money at 1%, I only need 6%. And now, or if I can borrow at 50 basis points in Japan, I only need 5 percentage points in order to make me ambivalent. However, if I have to borrow at 5%, I need 10%.
Yeah.
So that's going to mean I'm going to have higher growth alternatives out there. So could we make an argument counterintuitively that low interest rates manufactured over an extended period of time actually takes a lot of risk out of the economy, and therefore it takes risk taking out of the economy, and people get paid for the amount of risk with which they're willing to take, and as a result, when you do that, you actually put a ceiling on economic growth. Can we make that argument?
I think it's pretty easy to make, and I just think you have to understand that these issues in low interest rates isn't all kind of one-sided where it's all good or it's all bad. I mean, the other side of it is really low interest rates means governments can go out and borrow money or a lot more money
and waste it
and crowd out investments as
right.
well. And also higher interest rates, we've always learned that the long end of the yield curve is more about economic growth and inflation. So if inflation's a part of nominal growth, so if you are going to have higher long-term nominal growth, that doesn't necessarily sound like a bad thing to me.
I don't think so either. It kind of takes us to higher interest rates. If low interest rates extended over a period of time, manipulated by the monetary policies, what have you, aren't necessarily stimulative and arguably, maybe curtails economic growth. Conversely, that would mean higher interest rates aren't necessarily bad for economic activity. It depends on where they are relative to inflation, where they are relative to economic growth, and what have you. Now, don't get me wrong, when the Argentinians default on their debt yet again, their interest rates are going to shoot up to 25-50%. That's not healthy. That will curtail economic growth. However, if longer-term interest rates are really nothing more than the price of money in the markets, and if the markets are setting that price, then the way that I think that shouldn't necessarily be bad for economic activity. That's just the cost of doing business.
Right.
And if that's what the cost of doing business is, well, then I need to generate a higher rate of return, which means that I'm going to be taking a little bit more risk, which isn't a bad thing, and I'm going to be expecting to get paid more. And over a full investment cycle, that should be virtuous.
Yeah, we're in a period where people's expectations are kind of, at least largely, still stuck on where rates used to be. And, I think that's part of where some of the pain comes from and wanting. I mean, if you saw your friends have a 2.75 mortgage for 30 years and now you're going out at 7.3, that's pretty painful. But, the further you get away from 2.75, you kind of reset your expectations. And now, if they go back to 6, now maybe at some point that's going to seem like a good deal if rates have been at 7 for a long time. So you kind of reset your expectations and they're not stuck to something in the past.
Well, I mean, a lesson that a lot of people didn't learn in 2008 and 2009 is when the overnight rate has nowhere to go but up, that is not the time to tack on variable debt.
Yeah.
Just not. There's only one direction your mortgage payment can go, and that is sky high. You tack on that variable rate debt when it appears as though interest rates are going to go lower. Or there are a lot of people that just I need my monthly payment, and what have you, and it's a lesson that's going to have to be learned time and time again. Now, with that being said, how do you feel personally about a 10-year at 4.2, 4.3%? And I think we've discussed internally, if not here, it could be anywhere from 4.2 to 5.2, and I could make a justification on it in some form or fashion.
I don't, obviously it can have some headwinds to just risk assets as a whole, but I don't mind it. That seems way more normal to me than someone borrowing money, even if it's the federal government, for 1 point something for 10 years.
Well, particularly when inflation is clearly much higher than 1 point something.
I think it's whether it's up 50 bips or down 50 bips, we're at a more normal interest rate than we have.
Well, the thing about it is, it seems as though when we stumble from crisis to crisis, it seems as though the government or the monetary policy making authorities play a much larger hand in the crises than anyone would care to admit. The market plays the hands that the cards that they are dealt, and it'd be kind of refreshing to maybe see the markets determine what the price of money is. And when that's the case, I think we can maybe get away from these massive bubbles and all that stuff. I could be wrong. I might just be dreaming. I might be a 12-year-old trapped in a 55-year-old's body, or I might just be, frankly, a capitalist at heart. Sam, your thoughts on that?
I like it. It sounds kind of Austrian.
Kind of Austrian, yeah. That's my very bad impression, and probably politically incorrect impression of an Austrian. Very poorly done, by the way. So, Sam, I guess we're sitting here thinking about higher interest rates. Are they really necessarily bad for the economy? I think maybe we're not trading perspectives. Not necessarily. It doesn't necessarily mean it's bad for the economy. It could cause slower economic growth in the short term. In the longer term, it's just what the price of money is and cost of doing business, and it is what it is. And the businesses can get used to that. Is that a wrong assumption?
Yeah, no, I think that's fair.
On the flip side, lower interest rates, in the short term can certainly stimulate economic activity, but when lower interest rates or when low interest rates kind of set by the monetary policies are out there for an extended period of time, it seems to really kind of cause economic activity to slow down.
Yep.
Not necessarily intuitive. Maybe we're trading perspectives with everyone else in the world, but at least here today, we always love to hear from you all. So if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we have to say or how we think, you can always go online to oakworth.com, take a look underneath the Thought Leadership tab, and find all kinds of exciting information, including links to previous podcasts, as well as links to our blog / newsletter Common Sense, which comes out every Friday, as well as links to our quarterly magazine, Macro and Markets, amongst all other kinds of exciting information. That being said, Sam, any more thoughts on this topic here today?
That's all I got.
That's all I've got today, too. Y'all take care.